Hey guys, what is up? It's Arunat here. Unfortunately, I see way too many people investing based on what they think is the right investment, not knowing they might be gravely overpaying for those shares. Yes, there is such a thing as cheap and expensive shares, and I'm not talking about $10 a share or $200 a share, because share price alone means nothing. If you follow along this video, you can take your financial literacy to the next level, as I would like to show you a quick way how you can put a price on a company from a value investor's point of view, just like Warren Buffett, so you can better decide whether you are getting a great deal or paying a premium for your stocks. What you learn in this video might also protect you in case a market crash happens, which seems very likely from what we see today. But the good news is that this information is completely free, and all I ask in return is one subscribe. So if that sounds like a good enough deal to you, let's dive right into it. The other day I was helping out a beginner in a Facebook group answering some questions, and I recommended them to check out certain valuation methods to get a better picture when they are picking stocks. Even though my tip was appreciated, I was let know that they don't fully understand what those terms mean, and so they and other beginners would really appreciate a video explaining that, so here we are. When it comes to deciding whether a company's shares are cheap or expensive, it's important to note that there are no exact thresholds to go by, and that's true for the whole of investing. So investing is kind of like an art. You have to get a feel for it. And it might not be easy to find your own path at first. That's why I think it's important to ask. If you have any questions or something's not clear, please write a comment down below and I'll make sure to answer you and help you out, as I have replied to every single comment on my YouTube channel so far. But what makes investing a tad bit easier is that we have numbers like averages that we can use as guidelines when evaluating stocks. However, not all people are the same. In fact, people are different, so they value different parts of businesses differently with different weights, and as a result, we hardly ever come to the same number for the stock price at the end. However, we can generally be in the same ballpark. Let's see how some of that works. So in this video, I would like to introduce you to the price to earnings ratio, or PE ratio for short. Simply put, the PE ratio shows you how many years of profits it takes to recoup your investment in the stock. That's it. How many years of profits it takes to make your money back. Think about a house that you want to rent out. If the house costs you $100,000 and earns you $10,000 every year, then you need 10 years to make your money back. Now imagine you don't buy the house alone, but do it with a friend instead, who can offer you 1/100th of the price, $1,000, which you are okay with, so you happily take it, and you agree your friend will get 1/100th of the house and its profits, so $100 every year. So your friend put in $1,000 and earns 100 every year. Guess what? He also needs 10 years to make his money back. And that friend is actually you when you buy shares in a company. Because buying a company, or a share because they are proportionate, is the exact same. If you pay $100 million and the company makes $10 million a year, you would need 10 years to make your money back, meaning that the company has a price to earnings ratio of 10. Remember how I said stock price alone means nothing in the beginning? Right, this is how you make sense of the stock price and get the PE. Let's say you want to buy one share of Apple, because everyone knows what Apple is and what they do. The current price is $160.55. You grab what's known as earnings per share, or EPS for short, which tells you how much money the company makes in 1 year for one single share, the share that you want to buy right now. So if you pay $160.55 for one Apple share, which earns $5.61 in the company, as the EPS shows, now we can make something out of that. If we take price to earnings and put $160.55 as price to 5.61 as earnings and then divide it, we get a PE ratio of 28.62. Now you might understandably wonder what a PE ratio of 28.62 is good for. What does it mean to us? Is it good? Is it bad? Well, here's how you can decode any PE ratio. Imagine a scale for PE ratios. Now this scale has three separate segments that are somewhat overlapping. On the left, you have undervalued great deal stocks, while on the middle of the scale, you have fairly valued stocks. And on the right, you have a very long segment for overvalued expensive stocks because sometimes they get really expensive compared to how much money they make. So let's put some guiding numbers on this scale. The historic average for PE ratios is around 15 to 16, so that's what we would call fairly valued, in line with the long-term trend. People tend to consider stocks with PE ratios less than about 13 to be cheap because you pay relatively little for how much money they make, and for the opposite reason, stocks with the PE ratios above 18, 20, 25 are considered expensive. Now, we know the market average for the PE ratio, which is a good starting point. But the rest of these numbers are like a rule of thumb. Because nothing is set in stone, there is always some wiggle room depending on your assumptions about the future, as for what will happen with the companies you want to invest in. I personally start to pay attention when the PE is lower than 15 and start to lose some interest if the PE is higher than 20. Now this doesn't mean I have never bought anything with a PE higher than 20, but I always look deeper to see if there is anything that can justify having a higher PE and me paying a premium for how much money the company makes. Also worth noting as a little side note, when looking at stocks from the financial sector, mainly banks and insurance companies, PE ratio doesn't work that well there because they average lower PEs, and so all of them would just seem cheap all the time. So in those cases and for those stocks, you would be looking at other metrics mainly. However, you can still use the PE ratio to make relative comparisons between competitors within the same sector or industry. That works for tech companies, car companies, healthcare companies, everything, as long as you compare between direct competitors. So is a PE of 28, 29 that bad for Apple? It depends on who you ask and how you look at it. This is when you and your assumptions come into play. Determining whether a company is cheap or expensive is not like, bam, 12.5 is cheap, 13.5 is fairly valued. It doesn't really work like that. We can sort of agree that PEs of 2025 are for expensive companies. So Apple seems expensive as it demands a premium over the average. Now, why might that be? We know fast-growing tech companies and companies who are expected to grow a lot tend to demand higher PEs, so sometimes it's okay to buy more expensive companies. But Apple is already the largest company in the world, so how much and how fast can they grow? How hyped up Apple stock is? How hard Apple is to be replaced from people's lives? You see, all these questions emerge that different people weigh differently and can be used to justify a higher PE if there is enough supporting material for it. Take someone who really believes Apple is the best thing that has ever happened to us and that Apple is here to stay for at least the next few decades and still have market and room to grow, and that people will stick to using Apple no matter what. That person is likely happy to pay a higher PE because if all these assumptions play out, looking back from 15 years from now, buying at the current high PE might have been a ridiculously cheap option because of how much Apple is earning in the future that we today obviously do not know. Compare it to someone who thinks Apple has nearly exhausted all the market, they have very little room to grow, people will start to use other companies' products, and as a result, Apple will soon start to decline. Guess what? That person likely isn't going to pay any premium over the market average. And yet, they are talking about the same company and the same numbers. So then, what's the truth? How much should you pay for Apple? Well, it's for you and your assumptions to decide what price you can justify, what price makes sense to you. If you would like to hear some more tips, check out some of my other videos in the pop-out banner or the description below. I will leave some links that you can click so that you can watch away and learn as you go. There is one more thing I want to share with you, and I also plan to explain it in a future video as well, but that is how you can wear market crashes better. So if a market crash were to happen, which is rather a question of when and not an if, cheap stocks tend to fall less because they trade closer to their real value. Some fall in value will happen there as well, but likely way smaller than with companies having very rich evaluations and high PEs. That's because there are a lot of people, some of whom are beginners and are riding the hype, who are very ambitious with their assumptions and are happily overpaying when they are buying a stock with a high PE in hopes that their assumptions will play out on the long term. But if a market crash happens midway, these people will get so far away from their assumptions playing out that many of them will panic and will sell their shares even at a loss to preserve what's left. That's why I always recommend investing what you can afford to lose. That way it's a stress-free experience where you can only make money. And so these people panic selling and flowing out of the stock would mean reduced demand for that stock, which means a fall in prices on top of the market crash, which also makes prices to fall, which alone makes another set of beginner investors panic sell. So it's just a downward spiraling self-repeating circle. So buying cheap companies is sort of like flying under the radar, staying out of hype, and going for solid and boring companies that return your money relatively quick. While expensive ones usually have some kind of sudden growth potential or hype or status associated with them that can in fact really play out, just like how Tesla has unfolded so far. But the further away you are from what we usually consider expensive, the harder the fall is if a market crash or correction happens. I hope this video gave you some new insights. If it did, don't forget to like the video and subscribe to the channel for more content like this. Let me know in the comments what was your first ever stock that you have purchased, or what are the ones that you are currently looking at. My first stock was Nvidia, which played out quite well for me, even though I knew way less about investing back then. So I'm more than happy to help you out now if you are just starting out. Follow me on Instagram and Twitter at Mr. Arthur 9, and that's it for today. I hope you learned something new today. As always, thank you guys so much for watching, and until next time.